before you replace your entire first mortgage just to access cash. Compare the cost of keeping that loan and using a separated equity option. The lowest lock-in payment is not always the lowest long-term cost. This is Padma with Wuji Home Solutions. This is your weekly mortgage tip. Many homeowners and real estate investors have built equity in their properties. They may want to use that equity for a renovation, another investment property, business needs, debt planning, or another important goal. But accessing equity does not always mean that you should automatically replace your current first mortgage. If your existing mortgage has favorable terms, refinancing the entire balance could change the rate, payment, long-term, and the total long-term cost. That's why it is important to compare the full structure, not just ask, how much can I take out? Let's look at 3 common approaches. The first option is a cash-out refinance. With a cash-out refinance, the existing first mortgage is replaced with a new large first mortgage. The new loan pays off the current balance and the borrower receives part of the remaining equity as cash, subject to qualification, property eligibility, and the program guidelines. This approach may provide one combined mortgage payment, but you should compare the new rate, the new payment, closing cost, the new long term, and how much of the existing balance is being refinanced. The second option is a HELOC, or home equity line of credit. A HELOC is generally a revolving line secreted by the property. A qualified borrower may be able to draw funds as needed during the available draw period, instead of receiving the entire amount at one time. This can provide flexibility, especially when the total amount or timing of the expense is not yet certain. But borrowers should understand how the rate and the payment work, whether the rate can change, the draw and the repayment periods, fees, and how a second line affects the total monthly obligation. The third option is a closed-end second mortgage. This is a separated second loan that may allow a qualified borrower to receive a fixed amount while keeping the existing first mortgage in place. Unlike a revolving HELOC, a closed-end second generally provide a defined loan amount with a scheduled repayment structure. That may be worth comparing when the borrower knows how much is needed and wants to preserve the existing first mortgage. But the second loan still has its own rate, payment, term, fees, qualifications requirement, and the property guideline. Before choosing a home equity strategy, compare 5 things. What happens to your first mortgage? Total monthly payment, closing cost, how you need to access the money, and the long-term exit strategy. For investors, there may be additional questions about property cash flow, reserves, occupations, business purpose, and how the new debt affects the overall investment plan. There is no single option that is best for every homeowner or every investor. The right comparison depends on the current first mortgage, available equity, credit and income profile, property type, use of funds, timeline, and current program guidelines. If you are considering use property equity, I invite you to schedule a 30 minutes mortgage strategy consultation. We can review the situation and compare which plan may be worth exploring before you make a decision. You can use the calendar link in the description to make a schedule. Options are subject to borrower qualification, property eligibility, current program guidelines, and full file review. This video is for general education and is not a loan approval. Thank you for watching, and I will see you in the next weekly mortgage tip.